another type of receivable is notes receivable. Notes receivable are a more formal instrument than accounts receivable. And another big component that's different is that if you have a note versus an account receivable, the note receivable is also going to include interest. Now, if it's a note receivable, that means that you're going to be paid interest. If you were the one who owed that, it would be a note payable to you, and you would owe the interest. But we're going to be looking at it from the receivable side. So someone owes you money, and when they pay you back, they're also going to have to pay you back interest in addition to what they owed you. Now, you could have an account receivable that turns into a note receivable. So let's say that you had sold some merchandise, you provided services to a client or to a customer, and some time has passed, they have not paid, and they contact you and say, we're having some issues, and would it be okay if we know we're not going to be able to pay that for a little while if we turn that into a note receivable and you can charge us interest on it? So what you could do in that scenario is you can create a note receivable, okay, an asset. So let's say it was for, I don't know, $20,000. And you credit or decrease their accounts receivable. Now you've turned an account receivable into a note receivable. And again, that $20,000 is what we refer to as the face or the principal of the note. They're going to have to pay that back plus interest when this note is due. So let's talk about some different things with a note and different numbers and items that go along with a note. Again, different than an account receivable. We've already said there's interest included. And there's some terms we need to look at. So you have, sorry, erase that mark. The term maker. The maker or the payor, sometimes it's called that as well. I'll write this down for you. Got maker or payor sometimes. This is the person who is actually making the note. They're the one that's promising to pay the note in the future. So this would be your customer if you hold the note receivable. You would be referred to as the payee. This is the person that's going to be paid eventually the note. Along with the note, you'll have items such as the face amount of the note. Again, the face or the principal of the note, for us in this example I gave you, would be that $20,000. Sometimes it's just referred to as the amount of the note. Same thing. Okay. You'll have a issue date of the note, and that is the date that the note issued, and that's also the date that we're going to start calculating interest, which is important for us because it's a note, so there's going to be an interest component to this. You'll have an interest rate stated in that, and that's we need to know to be able to figure out how much interest they owe me, or if you're the one who is the maker, how much interest you'll be paying. So let's do some calculations considering those factors. Let me give you some information. Let's say that we have a note, and the face amount of the note is $100,000. Let's say that the interest that's going to be charged is 6%. Let's say the term of the note, how long the note will be extended, is 90-day note. And let's say that the issue date is May the 2nd. Right, so there's some pertinent information that we need to know about. Now, interest, when we talk about it, anytime you have an interest that's stated, it's stated at what we refer to as a per annum rate. I'll write that down for you. Per annum. And what that means is per year. So, for instance, if I said, okay, calculate the interest on this note. If you take the $100,000 and multiply it by 6%, that would be the amount that would be received if this note was for 1 year per annum. The 6% is an annual amount. But that's not going to be the case for this example because the term is not for a full year. It's only for 90 days. So anytime you're dealing with interest, you need to deal with an interest equation, which is P times R times T. Principal times rate times time. Principal is the same as face. The rate is the interest rate, and the time is the time component. Now with time, however, let me move this up if I can. Well, I'm just going to mark all over it. Hang on a second. See if I can get this. There we go. The principal for us was the $100,000. The rate was 6%. But the time is not 90, because if you did that, you would be calculating 90 years. Because remember, 100,000 times 6% is an annual amount. It's interest that would be earned within a year. So the time component is going to be whatever the term is over 360 days. We accrue interest or calculate it daily. So we'll put 90 divided by 360. We use 360 for these financial calculations, not 365. Okay? So 90 over 360. When we do that calculation, this is the amount that's going to tell me the total amount of interest on this note. If you do that math, should get $1,500. So that's the total interest for this note. Another term you'll hear referred to when we talk about notes, something called maturity value. When a note matures, it is due. So in 90 days, the note will be mature and will need to be paid plus interest. So the maturity value is the face or the principal plus interest. So for us, that's that $100,000 plus the $1,500 in interest. So the total maturity value is $101,500. That's the total amount that will need to be repaid to the payee on this note, or to us, if in this instance. All right, one other item we'll talk about before we actually get to making an entry for this deals with the due date. All right, I told you that the issue date for this was May the 2nd, and this was a 90-day note. So when exactly is this due? All right, a lot of different ways you can do this. This is just my way I do it. If you do it differently, that's fine. But I always start with, all right, we've got 90 days total, okay? And the first month is May. Well, it is May the 2nd, so how many days are left in May? Don't count the first day, the issue date. You start accruing interest, one day has passed. So on the 3rd, it's been 1 day. So May has 31 days, so we've got 29 left in May. All right, that leaves me with 61 total days left to account for. All right, so the next month is June. We've got 30 days in June. That leaves me 31 days left. What's next? July, and it has 31 days. Whoop, look, we're out of days. So when is the due date of this? July 31st. Okay. Now, another quick way, and you may know this shortcut, you may not, it may sound silly. It is something you might have learned in elementary school, but I find it to be very helpful. If you can't remember which months have 30 days, 31 days, some have, 28, 29, depending on the year, look at your knuckles for a minute. Again, just, bear with me, okay? Humor me. All right, if you make a fist, you look at your knuckles, and start with your first finger, your pointer finger, that knuckle, okay? The knuckle itself, or the top, the mountain there that your knuckle makes, all the knuckles, the tops, will be 31. Okay, so you start on your pointer finger, that's January. Then go to the little valley, or the indentation, in between your knuckles. That's February. Then we go back to the knuckle, March, the valley, April, the knuckle, May, the valley, June, the knuckle, July. Now go back to the original knuckle, August, valley, September, knuckle, October, valley, November, knuckle, December. Each of those knuckles is 31 days. Each of the valleys is 30 days except for February, which is normally 28. You got leap year there for 29. But that's an easy way without having a calendar or memorizing. There's also the 30 days have September, April, June, and November. All the rest have 31 except for February. But, if you don't want to memorize that little ditty, the knuckles are pretty useful to use. So Again, if that helps, use it. If not, okay, call me crazy. So, let me give you the journal entry now that we need to make for all of this business. So, when the note has been issued, or when it's made, okay, we now have a note receivable on our records. We record that note at the face amount, or the principal amount. Always the note receivable itself deals with the face amount. And then we credit whatever. It could be accounts receivable if we're turning an accounts receivable into note receivable. It could be cash if we literally lend out cash. Could be, trying to think of other scenarios. Again, if you directly extended a note, say, for merchandise, then the other side of this could be sales. So, it could be a variety of accounts. Just depends on the situation. But we've created the note. All right. Now, this is on May the 2nd. So, on July the 31st, the note has matured and is now due. So, they pay us the note. All right? So, we get cash. How much do we get? This should be the maturity value. All right? So, we calculate that. And if not, back this up. Look at how we calculated it. I'll give you another example in just a minute. But that was that $101,500. That's how much we should be paid because that's the full maturity value of this note. Now, they don't owe the note anymore, so we need to take the note receivable off of our records because they're paying us for it. So notes receivable we credit for $100,000. Because again, the only thing we have recorded in the notes section or the account is the face amount itself. So why the $1,500 difference? Should ring a bell. The $1,500 was the interest portion. We have nothing recorded for it yet. So this would be a type of revenue. We really did earn the interest because we extended them credit. So we record $1,500 in interest revenue. Okay? What if it was now July the 31st and they defaulted on the note? They did not pay us. It was due. It's mature. It's due. It's July the 31st. They're supposed to pay me, but they don't. Well, I'm not going to have cash because they're not going to pay me. They should have paid me, though. So I still want to get that money from them, and they still owe it to me. So we're going to create an accounts receivable right now for the full maturity value. We're going to take the note off because the note part is done, okay? It's not negotiable anymore. We can't accrue interest on that note because the term of the note's done. We're just going to move that full maturity value into an account receivable and try to still collect it. You still want to record interest revenue. You really did earn it. You just have not been paid for it yet. So the rest of this looks the same. But if, again, instead of being paid, it was dishonored, you're going to move that full maturity value into an account receivable and still try to collect on this note. Now let me give you one other example. Let's assume that we have a note, and let's say that this note, we've got still a face, same thing. The face is $100,000. The interest is 6%. The term is 90 days. And the issue date now, here's where we're changing something. The issue date is December the 2nd. Okay? So, when is this due? When is this due? Alright, still 90 days. Let's do my little calculation over here. Alright, December the 2nd. So how many days are left in December? 29. Gives me 61 days left. Alright, January has 31 days. That leaves me with 30 days. February, let's assume it's not a leap year, has 28 days. So we're left with 2. So that means my due date is, put it over here, March the 2nd. Now, none of our numbers will change here. I didn't change our interest rate or the face or the term. So all those calculations would remain the same. But I want to give you something different that we haven't considered. Let's say your fiscal year ends on December the 31st. Okay, I'll back this down just a minute. How many days are there in December? 31. We issued it on the 2nd. So how many days worth of interest have we actually earned this year? Because remember, we're under accrual basis. So any interest that's earned this year, I need to record in this year. I don't need to wait until it's mature and due and paid on March the 2nd to record all of the interest. Because if I did that, all of the interest revenue would be recorded in the next fiscal year. But we didn't earn it all in the next fiscal year. We earned 29 days of that this fiscal year. So I need to record those days this year, not wait until next year. So we're going to make an accrual entry. We're going to accrue interest earned this year. So let's do our interest calculation. All right, remember principal times rate times time. So the principal is $100,000. The rate is 6%. And the time right now is 29 days over 360 to figure out just those days. And that comes to not a nice even number, unfortunately. It comes to, if I round, 43.33 for those 29 days. Again, do this calculation for yourself. Double check it. Make sure that you have that right. Okay? So, on December the 31st, I'm going to accrue the interest I have earned. So, you should know that there's some revenue to recognize. I'm going to show that I've earned the interest. But I'm not receiving cash. No one's going to pay me cash until March the 2nd. So, I need to show a receivable. Specifically, I'm going to show interest receivable. And then I need to record interest revenue or interest income for this 483.33. Okay? All right, great. We've recorded this revenue in the correct period. We have accrued the entry. Now let's step forward to March the 2nd. So now it's time to show the receipt of the note. Okay, it's been due, it's mature, I'm ready to get the money for it. So on March the 2nd of the following year, we're going to get cash. And the cash we get is the full maturity value, which we know was that $101,500. So we debit cash for $101,500. Now, the note receivable needs to go away because they no longer owe it to us. They are paying it. But again, that's just the face amount. It's all that was recorded in notes receivable. Nothing to do with interest. But be careful. This time we can't credit interest revenue for $1,500 because all that $1,500 is not for this period or this year. We already recorded some of it up here on December the 31st. And what's sitting waiting for us this year? Interest receivable. Guess what? It's not going to be receivable anymore because I'm receiving the cash. So I need to take that interest receivable account off the books. So I need to credit it for 483.33. I'm not lining this up, I know, I'm sorry. The remainder will go to interest revenue. Now, you can say, well, it's a nice plug figure, I can figure this out. But as a double check, again, remember that's $100,000 principal times the rate of 6% times time, which, how many days did we have left? That was 61 days, I believe. So if you do this math, you should get the same amount that we're going to use in our journal entry. Okay? So yeah, you can get it as a plug figure, but there's a reason why this exists. This should be 1,016, again, if we round, 0.67. And that's the amount of interest revenue that we need to record in this entry for the maturity value, the due date, the receiving of this note. Okay?